Hello and welcome to this video. In this lecture video, I'm going to be discussing the introduction to budgeting. I'm going to be giving an overview of the budgeting process. I'm going to be talking about developing the budget and also relationships among the different budgets that we will talk about in subsequent lecture videos, okay? So when we really think about a budget, it's a financial plan. I had a lot of experience dealing with budgets when I was working as a financial analyst, and they would take a really long time. We would start the budget, I remember in late summer, probably around August or so, for the next fiscal year, and it would be extremely time consuming. We would have to start it off at a very low level and roll it up to the division level, and then so on and so forth, all the way up to the corporate level. And like I said, it was an arduous process, took up a lot of resources. But budgeting is also really important. It's really important for organizations, not just for-profit companies such as Hewlett-Packard, or at the time that I worked for, Electronic Data Systems, but even for nonprofit organizations and higher education institutions such as Mary Washington. The budget process is very, very important. It can also be highly political. And I don't mean political in terms of Republican, Democrat, although that certainly does come out. I mean more political in the sense that people in the budgeting process, I've seen it before, where they try to protect their own divisions. They try to protect their own turf. There's a lot of that in the budgeting process. So that's something to really look out for when you start working and you go through a budgeting process to see, why are people making certain recommendations? Is it really for the good of the company, or is it for the good of their own division? So just keep that in mind, that there's a lot of political motives that come out in budgeting, okay? So that's a little bit about my experience with about budgeting, but if we think about what a budget is, as I was saying earlier, it's just a financial plan. So it tells us, how much money can we spend in different areas, and how much money do we think how much income do we think we'll make? How much sales do we think that we'll have? What do we think our overhead expenses will be? How much direct labor do we think we'll have? How much will we have to pay for materials? So it's a plan that helps us out in achieving our strategic objectives. And I would also say, this is just kind of my opinion, that you can really tell an organization's priorities by looking at their budget. Which areas get the most resources? That's what their priorities are, because they're, so to speak, they're putting their money where their mouth is. Okay. Budgets are also used for control purposes. And so when I say that, they're used for evaluating performance. So for example, one of the things that we used to have when I worked as a financial analyst, a management accountant, is that we would have certain targets for our military systems division. Corporate would say, for example, you have to make this much money. You have to have this much in income. You have to have this much in sales. And if you can't make this, they may say to the manager, well, if you don't make this for the year, if you don't hit this number, you may not get a bonus. You won't get your bonus. And if this continues, if you don't hit this number, if you fall short of hitting your revenue targets or your income targets, we may have to get a new manager in the future. So that's what I'm saying here, is that they're used for evaluating performance. And that's something really important to keep in mind, because that will happen. Okay, that really will happen a lot. When we talk about developing the budgets, they can be prepared for departments, divisions, or the entire company. And as I was saying earlier, that in my work experience, I was more at the department level, and then we would roll those up to the whole military systems level, and then eventually that would be rolled up into the entire company, okay? You can also have a budget committee that would be composed of some senior executives. When we talk about approaches to developing the budget, we can talk about a top-down budget or a bottom-up budget. So when I worked, I dealt with top-down budgets. And so basically with the top-down budget, what would happen is that corporate would tell military systems, which was the division that I was a financial analyst for, they would tell military systems This is how much revenue you have to have. This will be your profit targets. This is how much profit we want you to make for the next year. This is how much revenue we want you to make for the next year. If you don't make those, you may not have a bonus. Or if it's a continuous problem, if it's happened before, we may have to find a new manager. But it was imposed, that budget was imposed upon our division from senior corporate leadership. I'm sure we had some say in it, although I wasn't really privy to a lot of those conversations because I was a low-level worker bee financial analyst. But from what I could tell in my work experience, it was top down. Corporate said, this is the number that you have to have. Okay. And that's what we would mean by a top down budget, that senior executives tell lower level managers, we need you to make this much in revenue and this much in profit. And this is what we need. Okay. Little input from lower level managers. On the other hand, you could have a bottom up process where if I'm the CEO and everybody in my class are lower level division managers, and I say to you, how much profit do you think you can make? How much revenue do you think you can make? And I'm asking you, and then you tell me, and then I use that as input to develop the whole budget. That would be more of a bottom-up approach. I did not see this used. I saw this used when I worked in industry. The problem with this, there's pluses and minuses to both approaches here. The problem with this approach is that if I'm asking lower level managers how much profit do you think you can make, and then I say, well, your bonus is dependent upon hitting that profit number, they're going to give me low estimates, right? They're going to give me low ball estimates. But on the other hand, the bonus of this is that I am involving them in the budgeting process, which can improve their commitment to the budget and also their morale. On the other hand, over here with the top down, the bonus, the positive would be that I don't get a whole lot of low ball estimates for profit. I'm telling lower level managers this is how much you have to make. But on the other hand, people aren't going to be very happy if you impose unrealistically high profit numbers on them. They're not going to be happy about it. And so it can lead to morale problems up here and people just saying, well, this is just not a realistic budget number for me. And then they get frustrated. Okay? So it causes some morale problems. We could prepare budgets for short-term horizons, long-term horizons. Again, when I worked, it was seemed to be more of on an annual basis. Okay? Let's talk about the master budget. So the master budget is a comprehensive planning document, and it's composed of all these different sub-budgets. We have a sales budget, a production budget, direct materials budget, direct labor, manufacturing overhead, selling and admin, capital acquisitions budget, cash receipts and disbursements budgets, budgeted income statement, and then a budgeted balance sheet. We have all of these different sub-budgets which comprise what we call the master budget. And what we will be doing in subsequent lecture videos is going through and describing how we do each one of these budgets. And then all these together comprise the entire master budget. Okay? Let's talk about some relationships among the budgets over here, okay? So what I'm going to do is I'm going to flip the page over and I'm going to talk about this diagram because this diagram does a really good job of describing the relationships among the different budgets. So we have a sales budget, and the sales budget is always going to be the first budget that we do. I'm going to repeat that because that could be a possible test question for you. The sales budget is always the first budget that we do. And why is that? Well, the sales budget says this is how many we think we're going to sell. So if you think about this in terms of if you just wanted to start a lemonade stand, right? Would you go out and buy 50 cans of lemonade or 50 boxes of lemonade mix? Probably not. What would drive your decision that says how much lemonade mix do we need to buy? You'd probably have in your mind, well, how much do we think we're going to sell? That would be the first thing that you should think about. It's the same thing over here with the organization a bigger organization is that we first have to figure out how much do we think we're going to sell, okay? And then that drives how many units we think we're going to make, which shows up in the production budget, okay? So the sales budget says, how many units do we think we're going to sell, and what do we think our sales dollars will be? The production budget says this is how many units we need to make. So kind of like, how many cups of lemonade do we think we're going to sell? How many cups of lemonade do we need to make? Now, when you look at this production budget, as we'll see when we go into more detail on this, it's not just we need to make enough to cover our sales, but we also need to make enough to maybe have some extra just in case our sales estimate was too low. So for example, if we think we're going to sell 50 cups of lemonade on a day, maybe what we want to do is make 55 cups just in case, so that we have an additional 5 cups that we could sell in case people want more of our lemonade than we thought. So we want to have some extra inventory in there just so we don't have stock out. So we don't tell people, oh, we don't have any more lemonade. Okay. So we have to do our sales budget, then we do our production budget. And then from there, we can say, well, this is how many cups of lemonade we think we're going to make, how many we think we're going to sell, how many we think we're going to make. Now, how much lemonade mix do we need to buy at the store? How many people do we need to employ at the lemonade stand and to help us buy all the lemonade from the store? How much overhead do we think we're going to have? Maybe we have a supervisor who's watching over the various lemonade stands. That would be overhead over here. Or maybe what we have are some extra lemonade tables to set up to sell the lemonade, getting into more overhead over here. Then we can come over and we can look at our cash budget. So once we've done these budgets, we can look at our cash budget. So with our cash budget, we'd say, well, maybe some of the mix we buy it now, but maybe some of it we'll pay for later. We put it on the credit card, and then we'll pay it next month, but some of it maybe we'll pay for this month. Right? It depends upon our credit terms with our suppliers. We also have to pay for our direct labor, so that comes into our cash budget. And then we have to pay for our overhead, and that also comes into our cash budget. And you can also see this arrow coming from the sales all the way down in the cash budget. Now with a lemonade stand, we're most likely going to be selling our lemonade for cash. But let's just take the example a little bit further, and let's say maybe we're a really enterprising lemonade stand, and we were able to extend credit to our customers. We could say to our customers, you know what, you don't have to pay us now, you can pay us later. In that case, we may not receive cash for our lemonade until a later date. Okay, if that were the situation, we would have accounts receivable, and we have to figure out when are we going to be collecting on our accounts receivable. Okay, the sales budget also has to be done before we have our selling and admin budget, because what if we offered commissions? Okay, commissions are dependent upon sales, and commissions expense would show up here. We have to do our cash budget before we do our budgeted balance sheet, because cash is a line item, it's a current asset on the balance sheet. Okay. We also have to do our sales before we do our income statement, because sales shows up on the income statement. So we can't do our income statement until we know our sales. And then we can't do our income statement until we know what our selling and admin expenses will be. And then finally, this link over here, we can't do our balance sheet until we do our income statement, because remember, income rolls into retained earnings or capital, which shows up on the budgeted balance sheet. Okay? So a lot of what is said over here, a lot of this text over here, I just kind of covered by going over this diagram, okay? I think that this diagram does a very good job of describing all the different relationships among the budgets, and it's important to know those because on the test I could ask you questions about different scenarios, which budget would be made first, and so on and so forth. So the right way is not to memorize this, but to think it through in the context of a lemonade stand. Thank you.